Yes. Just throw it down the stairwell. Okay. Bye. Okay. Bye.
Hello, folks. Good afternoon or good morning, depending on where you are. I know I jumped in here. Winston may have already said hello, but just in case, I'm Jacob Dumais. I'm a fellow with the Student Borrower Protection Center, and welcome to this training. We're going to continue to let folks jump on here, and then we will get going in a second. As you probably saw, we are recording the meeting, just as a heads up for you. And I'm going to repeat this as more folks join, but since we have a large enough crowd today, I think at any time that folks want, you can go ahead and sort of introduce yourself a little bit in the chat. We'll continue to encourage people to use chat to interact with us and ask questions, but up front, if you want to just say where you're coming from, what your role is, anything fun that you're up to in the chat, that would be great. Thank you.
Yeah.
Again, welcome, folks. I'm just figuring out if I need to do a couple different things.
The internet goes down when there's a lot of people that log in.
Yeah, sorry for anyone experiencing any internet troubles. I know that feeling all too well. Welcome, Claudia, Adriana. Winston, I'm sorry. I'm going to go ahead and just ask you this here because I want to make sure I'm doing the right things with the tech. Are you okay? Great. Perfect. Well, welcome for folks who've continued to join again. My name's Jacob Dumais. I'm a fellow with Student Borrower Protection Center, focusing on the city's partnership and work with cities. So excited to have you here today. We're just going to give folks a couple more minutes because we had a good sized crowd. I'm excited to see lots of folks I know and lots of folks in the meeting for the first time. So welcome again, Michelle. And for those who have just joined, I've encouraged, because we have a large crowd, but want to let people have some say hi to each other, to go ahead and use the chat to introduce themselves as you're seeing others do. Hello again, and hi to folks who just jumped on. Jacob Dumais, fellow with Student Borrower Protection Center. Happy to have everyone here today for the student debt training for financial coaches and frontline staff. We're going to get going in a second, so I'll just start off with a little bit of housekeeping and welcome. First of all, really excited to have a great group with us. As you can probably tell from the name and from how you were invited to this, primarily this is a training for folks who engage in financial coaching or counseling activities with cities, with one likely of our city partners. This is a city partnership program with SBPC and 14 cities and counties across the country, increasing capacity and resources for folks to work on this really pressing issue, helping borrowers, families, and communities deal with student debt, which has truly become a crisis. You can't avoid it in the news recently, so we will get to that. We will talk about the Supreme Court and what how the president has reacted and what's going on. But we'll also kind of ease you in with a general overview. And Winston's going to be a great presenter for you all today. I'm going to ask, if you haven't already, please do mute yourself. There will be times when we will ask folks if they have questions or have some more interaction. But in the interim, please do mute yourself. As a reminder, the meeting is recorded, so that will be accessible to share with colleagues back at the office or for you to rewatch. We can also make the presentation slides available to everyone. And this won't be the last time we do this. We're thinking about what the next couple of months looks like, but expect to have at least one more training sometime later in the summer or early in the fall. And so folks who couldn't make it today or folks who just want to join on and have a little refresher will have the opportunity to do that. That is largely what I wanted to say, but I have one more important note. I wanted to make it pretty easy for folks to access this, and so left the original calendar invite up and just put the Zoom link there so you didn't have to go through a registration process. But I do really want you all to fill out a post survey that I'll be sending around either today or tomorrow. It'll be really important for us to have that good contact list so that if we need to send any really timely updates about how you're going to work with clients on student debt, how policies or programs are changing, et cetera, that we can do that directly, which is really good. And also, we'd really like to hear how this training went and where we might need to focus more energy. A couple hours is going to be great for this meeting, a good amount of time, but obviously there's going to be more places where we can do a deeper dive. So please, when you see that coming from me, do fill it out, do encourage your colleagues to fill that out as well. That's about it for me. I want to get out of the way today. I will say, as you see people using the chat to introduce themselves, please continue to do that. If throughout the presentation you have a question or comment or need some help, I will be watching that. And so you can drop your questions there. We also may have a time where we just open it up where you can raise your hand and go ahead and talk. Winston, I'm not going to do a big introduction for you, but I would love for you to perhaps introduce yourself right at the top. And so I'm going to hand it over to Winston Berkman-Breen with the Student Borrower Protection Center.
Great. Well, thank you, Jacob. And I'm just going to do a brief intro of myself because I want to get to the content.
I didn't intro.
But if folks are just joining, we're just getting started. So if you haven't missed anything, just ask folks to mute themselves or double check they're muted. So as we jump in, there are no disturbances for other folks. So again, my name is Winston Berkman-Breen. I'm the legal director with the Student Borrower Protection Center. We're a national non-policy group focused on student debt in its varying forms. As Jacob mentioned, sort of a hot topic right now for many of the folks in your communities and that you serve. This has been a long-standing source of financial sort of strain and pressure. So what we're going to focus on today is a little bit less policy and a little bit more practical, just providing a background on student debt, like the products, like student loans, how to understand what your constituents, residents, clients might actually be working with, and what some general categories of relief for them might be, ranging from payment plans to getting out of default to getting debts canceled altogether. And in subsequent trainings, Jacob mentioned we'll have more of these. We can get a little bit more fine-grained on any one of these programs, but the goal today is to give you a sense of the breadth of what's available out there, and then direct you to some resources for follow-up whether that's follow-up training or follow-up to your meeting with a client. You remember you learned about this thing on the webinar, and then where do you go to get more resources about that for your actual client work? We have, I think, 2 hours, and this is not a 2-hour presentation, so we will have plenty of time for questions and conversation, everything at the end. Please do feel free to use the chat. Just the way that my screen works, it's hard for me to be in presenter mode and monitor the chat at the same time. So I guess I'll deputize Jacob to just unmute and flag things for me if there's something in real time that we want to stop and talk about, just because it can be a little bit difficult for me to sort of walk and chew gum at the same time. All right, so what I'm going to do is share my screen, and then we will get going. And we can make all of these slides available after the fact as well. Okay. Can I get a thumbs up that you all see the welcome slide deck? Okay, great. So let's just see if I can drag this out of the way there. Great. Okay, so here are our goals, right? Really want to just high level landscape, make sure that if you are advising someone, you have a sense of what this student debt, student loan landscape looks like. We are going to be focusing on student loans today. There's all sorts of types of student debt, but loans is sort of the primary bucket, certainly for a lot of folks that you might be serving. We're going to talk about issue spotters. Again, in follow-up sessions, we can do more deep dives into particular issues, but just in general, what's a good way to flag when someone walks in the door, and then follow-up resources. Those are the goals. What we're actually going to do is walk through all of these things, right? Some of these are a bit faster than others, but this is what we're going to cover overall today, and can follow up with questions on the Zoom or afterwards about any of these individual topics. Okay, and again, if I'm going too fast or something comes up, just Jacob can flag for me. And then if folks can stay on mute and use the chat at the beginning, we can then have a conversation afterwards. Okay, so quick overview. So what are we really talking about here? So the student loan debt market is a roughly $1.7 trillion market, and it's composed of really two buckets of products, not two types, but two buckets. And those are loosely federal student loans and private student loans. Federal student loans make up about 90% of the market. Private student loans, which is that sort of baby blue at the top there, is about the remaining 10%. I say about because there's only sort of imperfect data on this, but that's the rough breakdown. And even the private student loan market, coming in at around 140 billion is still substantial, certainly on a household budget level. Now this, and you can see the other slices of this pie are subcomponents of the federal student loan portfolio, which we'll talk about. This is also a growing area of consumer debt. After mortgage debt, student loan debt is the largest household consumer credit portfolio out there, and it's greater than auto debt, credit card, HELOCs, and other sorts of things. So after sort of home purchase mortgage debt, student loans come in at number 2. And you can see that that's changed over time, on the right-hand side being the closest to today. It also is a consumer credit portfolio that experiences a lot more delinquency than other consumer credit products. So again, same other products that were on the previous slide are outlined here: mortgage, auto, HELOC, credit card, etc. That thick line at the top is student debt, and what this is showing is delinquency rates. So pre-COVID payment pause, March 2020, student debt had the highest delinquency at about 12% of any of these products, right? And that's greater actually than the mortgage delinquency rate during the financial crisis of a little over a decade ago. What these boxes are, just to sort of walk through what this map looks like, is each of these boxes are when the federal government introduced a new, more affordable repayment plan in an effort to reduce delinquencies. And what you can see is that none of them had that effect, right? So they allowed for, we're going to talk all about these, so I'm just sort of brushing over it for now, what these plans are. But you can just see that the policy interventions to address delinquency were really ineffective with respect to delinquency until we hit the payment pause, which is the red bracket at the very end. And that is ending later this year and is also not a permanent, therefore is not a permanent solution. And we can expect delinquencies to sort of spike again, short of there being other policy interventions. And we're going to talk more about all of these things that I've just said. So this is just sort of an overview. I should also note that we're not really going to dive into the sort of socio-racial economic components of student debt because we're really focused on the products and how to address them. But I just have a couple slides to make the point that there are really grave and significant socio-racial economic components of student loan debt, intergenerational wealth accumulation, wage gap implications, et cetera. Here you can just see a graph showing that majority Black zip codes generally have higher balances than majority white or majority Hispanic zip codes, and that after 20 years of repayment, Black borrowers typically have only decreased their principal balance by 5%, whereas their white graduating classmates have decreased their balance over the same period by 95%. So there's just repayment outcomes that vary across borrower types as well. And again, this could be its own slide, its own 2-hour presentation, so I don't want to make light of it, but just want to make the point that there are really dramatic social implications of student loan debt, and aside from the one-on-one counseling importance. And then again, there's different types of student debt, right? So this sort of pairs with the pie chart we saw in the beginning. There's federal student loans generally, and there are private student loans generally. Within federal student loans, there are different types. And the best way to think about this is that there are sort of 3 types. Today, the way the federal student loan system works is that the Federal Student Aid Office within the Department of Education is basically a bank. It's basically like the world's largest consumer bank, and it just cranks out student loans. And these are called direct loans because they're made directly by the federal government. They've been the primary student loan type since 2010. So if someone took out a loan since 2010 to present, it is almost definitely a direct loan type. Another type of student loan that is a federal student loan is it's called a FFEL loan. And if we could, Guadalupe, if you could mute your, let me see if I can go and do that administratively. Yeah. All right. The second type is what's called a FFEL loan, or a Federal Family Education Loan. What these are, they have not been made since 2010. The direct loan program sort of replaced them. But what these FFEL loans are loans that were made by banks, like main Wall Street banks, that were guaranteed or insured by the federal government. So there's still federal student loans, and that they have all the protections and rights that we think about with federal student loans that we'll get into on this call. But the entity that literally owns them and benefits from the payments is not necessarily the federal government. It's counterintuitive that there are privately owned federal student loans. And that's what these FFEL or FFEL or FFELP, you sometimes see with a P, loans are. They're a diminishing portfolio, which is to say they're not being originated anymore, so they're being either paid down, or there's a function by which when someone is struggling to repay on them, the federal government will kick in on the insurance component of it, and they'll take the loan from the private owner, and it'll become a government-owned government loan. Or, and we'll talk about this, there's a way to convert your federal loan type, and so you can convert from a FFEL loan to a direct loan. All that is to say that there are some FFEL loans that are owned by private banks, and there are some FFEL loans that have ended up being owned by the federal government. And we'll get into that distinction in a couple slides as well. The final major portfolio of federal student loans are loans called Perkins loans that are similar dynamic to FFEL loans, but they run through schools and they're for lower income students. So your school will originate a Perkins loan to you through a federal program. That program also ended a couple of years ago, about 5 or 6 years ago. And so there is a fixed and diminishing portfolio of Perkins loans. The same dynamic exists where there are some Perkins loans that are still held by the school, and there are some Perkins loans that are held by the federal government. That is, I think, the majority of the federal student loan landscape. There are a couple other types out there, but you're really going to run into direct loans, FFEL loans or FFELP loans, and Perkins loans. In the private student loan world, it is, on one hand, less complicated, on the other hand, more diverse, right? Because there are some guardrails around what private student loans can look like, but they can be made by banks, by non-banks, by schools, and it's really any private, it's like any loan product that is not made or guaranteed / insured by the federal government. Private loans have some federal laws that apply to them, but are mostly governed state by state by state banking laws and consumer protection laws. Okay, so continuing to focus on federal student loans, as many of you are likely aware, there are these intermediary companies once a loan is made called student loan servicers. So student loan servicers are, for the federal student loan context, private companies that have a contract with the federal government to administer and sort of be the borrower-facing company for federal student loans. So you see a number of the contractors here, the student loan companies that work for the Department of Education and the Federal Student Aid Office, or FSA, within the Department of Education. Nelnet, Ed Financial, Advantage, Mohila, ECSI, there's a couple more that I didn't put on the slide. You probably are also familiar with big companies that used to do this and no longer do this, Navient or FedLoan. Those companies still exist and they still service student loans, but they don't service federal student loans. They don't have a contract with the federal government to do that. So again, these are the companies that process monthly payments, that answer customer service calls, and that are supposed to be tracking sort of the borrower's progress towards repayment, and processing applications for any of the programs that we're going to talk about later on. FSA itself does very little of the actual day-to-day on these loans. They contract it to these companies. Private student loan world, you have both of this model of student loan servicers. So you have lenders represented here by SoFi or Citizens, and then you have companies that service them, some of whom also service federal student loans. So it can actually be very confusing. Someone understandably might not know what kind of loan they have because the same company can service both types. So just knowing who your servicer is isn't necessarily an indicator for knowing what kind of loan you have. And then there's a private student loan model where the lender also services, right? So like a Discover Bank will make a student loan and then service that loan as well. So again, a little bit more diversity in the private student loan model. So continuing with understanding the landscape here, I already sort of talked about this, but when in the federal student loan context, there is this distinction between federally owned federal student loans and privately owned federal student loans. So you just see that put out into a table here. All direct loans are going to be federally owned because they were originated by the federal government, and the federal government does not sell or assign loans to private companies. They only used to guarantee them. And then the federal government also owns some FFEL loans and Perkins loans that they have taken over from private owners who originated them privately through a government program, but the federal government has taken them over. On the private side, you have those Perkins loans that are still owned by schools, but are part of a federal program. You have those FFEL loans that are still owned by private companies, but are part of a federal program. And then you have private student loans, right? So this is sort of hopefully a helpful matrix to think through that distinction between loan type and loan ownership. In the ownership, I'll try to sort of, be careful and be clear as we talk throughout the presentation, but you might hear me refer to something as being held by the federal government. That just means owned for all purposes. So if I say it's an ed or government held FFEL loan, I'm just referring to this left-hand column here, where it's the FFEL loans that at some point the federal government has taken ownership of. All right, and sort of again, just wrapping up the sort of high 50,000 foot landscape of the student loan system, just what is even the life cycle of a student loan, right? And this is pretty similar to private student loans, but we're going to talk about federal student loans because again, they are the majority of the debt, the majority of the loans out there. So the loan will be dispersed. When you go to school, it's part of the federal financial aid process. You fill out the FAFSA, you apply for federal financial aid, and then your loan gets dispersed. You can go to the school, part of it can be dispersed to you for expenses. When you're in school, there's an in-school status, an in-school deferment for federal student loans. So your payments are not due on a certain loan type. Your interest will start to accrue. That's called an unsubsidized federal student loan. And on another federal student loan type, interest will not accrue. The government will cover it basically. That's called a subsidized federal student loan type. You will see, if you look at student loan records, that distinction stays with the loan throughout the life of repayment, but it doesn't have any relevance for the most part outside of this school context. There's other instances where it can be, but for the vast majority of the time, whether it's subsidized or unsubsidized, has no relevance for repayment plan options, for forgiveness plan options, but it does stay in the title, in the loan description throughout the life of the loan. So you are in school, you're not making payments, some of your loans may be accruing interest. You will then have a 6-month grace period from when you exit school. It's not necessarily when you graduate, it's from when you are no longer a full-time student. You'll have a 6-month grace period before payments are due. Unpaid interest from those that have been accruing interest can be what's called capitalized. They're folded into the principal of your loan. And so once you start accruing interest on that capitalized loan, you're essentially doing interest on interest, right? So the principal balance will look a little bit bigger when you enter repayment than it did when the loan was dispersed. Now, in between the grace period and when repayment starts, that's when student loan servicers are going to start sending bills. So there may have been very little communication between a servicer and the borrower up until this point, but then in advance of their first repayment day, they're going to get a statement, usually 21 days or more in advance, and then monthly thereafter from whoever their assigned servicer is in the federal student loan servicing population. Most people, like undergrad debt especially, is going to be automatically placed on a 10-year standard repayment plan. And we're going to talk about repayment plans starting in the next slide. But the big takeaway is unless you do something affirmatively, you're going to be on a standard repayment plan, which basically says, how big is your debt? How long is your repayment plan? 10 years, and just chops it up so that each of your monthly payments over 10 years pays down to $0 after 10 years. So again, that is the sort of like quick landscaping of the different student loan products out there, where they come from, the role of servicers, and what the life cycle of a student loan looks like. We're now going to talk about the actual repayment plan options, right? And I had started to just do that. So there's basically 4 buckets of options that you see represented here. The top left is that standard repayment plan. It's usually 10 years. Certain loan types, especially consolidation loans, can have longer, 20 or 30 years. But it basically, again, says, what's your repayment period? How much do you owe? And that's how we get to your monthly payment. 2 other plans are what's called the extended repayment plan. That, as the name suggests, it stretches out your repayment horizon, how long you're in repayment, but you still owe the same amount, right? So it reduces your monthly payments as a result of that. So it's lower payments for a much longer period of time than the standard plan. The third option is what's called the graduated repayment plan. And you see just graphically, to make sure we're all on the same page, the way that these repayment plans are visualized here is that the 3 purple plans are that you see on the top right and bottom are not the standard plan, but how much you pay on the standard plan is represented in those 3 by that red bar. So on the top right, the extended, your payments are lower, is represented by the purple, and you see that it's lower because it's lower than the red bar. On the graduated, as the name suggests, you start with a lower payment and then it steps up over time and ends with a higher payment. And that's lower and higher relative to what you pay on the standard plan. And that's why you see those purple step lines interacting with the red line that way. And then the final bucket is what's called the income-driven repayment plans. And we're going to spend a couple slides talking about these, but these are plans that peg your monthly income, not to your total debt, the way the others do, but to how much you make. It's going to be a percentage of how much you make. And that can result in fluctuating monthly payments, which again, you see here represented by the sort of zigzagging line above and below the red standard repayment plan line. As I'll discuss in a moment, these income-based repayments can even be as low as $0. So what is considered a payment, even though it's a non-payment, because it's $0 if your income is sufficiently low. So let's spend a couple of minutes talking about those income-driven plans, because for a lot of people struggling with their loans, this is sort of the best option for long-term affordability. So the IDR, or income-driven plans, are actually a umbrella term for several plans underneath it. One is income contingent, or ICR. One is income-based repayment, or IBR. One is pay as you earn, PAYE. And the final one with a little asterisk on it, which I'll explain in a moment, is repay, or revised pay as you earn. They all follow a similar model, which is that they take a certain percentage of your discretionary income, and that is your monthly payment. The percentages, and they have slightly different eligibility for each plan, and we're not going to get into the sort of details of them, but you see some listed here. Certain loan types are eligible for certain plans. For certain plans, you have to be experiencing an economic hardship, for example. And again, there are other sort of eligibility requirements. For most people, the repay plan is going to be the most generous. So the repayment are calculated, again, with some variation, but the concept is the same across all of them, by taking either 10 to 20%, 10 to 15%, one of them is 20, but 10 to 15% of your discretionary income to determine your monthly payment. Because you then, if you're doing annual, well, I'll get there, but your discretionary income is itself a defined term, and that is your annual adjusted gross income minus, for the majority of the plans, 150% of the federal poverty level. So I sort of plugged in for this slide what those are currently for 2023. HHS publishes these, they're federal guidelines. And so if someone, so 150% of the federal poverty line for a single borrower with no dependents is going to be $21,000. So someone who makes $21,870, to someone who makes $21,870 or less, per this calculation, they're going to take 10 to 15% of their discretionary income, which is any income above 21,870, which is zero for them, that will result in a $0 payment. If they make above 21,870, you're going to take 10 or 15% of that divided by 12, and that's the monthly payment. For a family of four, given today's the effective guidelines for today, 150% of the poverty guidelines are $45,000. So that's a family with, a four, two dependents, or one person and three dependents. Again, anything if they make a 45,000, 10% of that is zero because it's all protected, and above that it'll be 10 to 15% of whatever is above 45 divided by 12. The Department of Education does have a repayment estimator, and you can log in to studentaid.gov, talk about this website, and it'll plug in your actual loan information and give you a pretty accurate estimation of what your payments would be under varying plans. You can also manually enter loan data if you don't want to log in, or you're just sort of experimenting to see what different permutations you can get. So I'm going to come back to the sort of the figures here, but just some general comments on IDR. So historically, and you may have had this experience yourself or in your work, historically, this was a sort of fraught plan because although it allows for lower monthly payments, first of all, it wasn't always affordable for some people. It depends on what your income is and what your other expenses are, because it does not take into account expenses, right? It just takes into account income. But for some people, if they had a sufficiently low payment or a $0 payment, they were not covering the interest that accrued each month, which meant that they were interest was building month to month, and that's okay. They weren't doing anything wrong, but the effect that has is the account balance goes up. So when you hear stories of people like, I borrowed 20,000, I pay on time, suddenly I have 80,000, what's happening? That's what's happening, is that they're making timely payments under a legitimate plan, but it doesn't cover the monthly interest, so it grows and grows and grows. And if you remember from the life cycle of a loan slide, there are some times where that interest capitalizes, gets folded into the principal balance, and then you have a bigger principal and you start taking interest on that. So it's sort of an interest on interest situation. That concept is called negative amortization, right? Where your balance is going up, not down. That would happen under IDR for all the reasons I just said. That's a very emotionally distressing for people who are already feeling distressed because of their finances. And it can also have some financial effects as well, just because they have a large debt that they owe, right? And a growing debt. So a way to think about this is to sort of reframe the goal here. So a key thing that I didn't mention about IDR, but is related to the negative amortization, is because of that, there is a feature of all of these plans that they will cancel discharge the entire debt after a certain period of time, which is 20 years generally for undergrad debt and 25 years for graduate debt, parent debt, or a combination of undergrad and graduate debt. There's a type of federal loan that parents take out called a Parent Plus loan that is for their child's education. So they're the borrower, not the student. Normally you're both. And parent loans are also on the 25-year track. So IDR is both an affordable payment plan, but it's also a debt cancellation program. And it's important to work with clients and make them know that you might see your balance go up, but the goal is not necessarily to pay down your debt. It's to have monthly affordable payments. And then at the end of the day, a long time, and this is where it's important to recognize that it is a long time, just to like not feel like you're sort of gaslighting your client or something. 25 years is a long time, but at the end of that, the debt will be canceled. So the fact that the balance is going up isn't necessarily a bad thing, but you just have to sort of have that mentality. Another feature of IDR that is complicating for some people is that you have to annually certify your income based on your prior taxes or whatever your income is at that point. And if you don't do that, you can get dropped out of the program, which you just have to recertify to get back into it. But it does mean that any time out of that program doesn't count towards that cancellation horizon. So if it takes you 6 months to, get your life back together and recertify, you're going to be 20 years and 6 months till you get cancellation and so on, right? So you have to sort of on time recertify. You do get a notice, but it does take an affirmative step to do that. So those are sort of the overview of these plans and their pitfalls, but also their benefits. One exciting thing is that the president just 2 weeks ago, 2 weeks ago tomorrow, announced a new IDR plan called the SAVE plan. It's going to replace the one of the plans, so I'll talk more about that. But it's going to be more affordable. They're increasing the protected income, the discretionary income, from 150% of the federal poverty level to 225%, right? That's a significant jump. They're also, for undergrads, for undergraduate debt, they're going to reduce the monthly percentage you do from 10% to 5%. And if you're someone who is undergrad and grad debt, they're going to do a weighted average between 5 and 10% for how much of your income you have to pay above that discretionary level. What I mean by weighted average is if you have undergrad debt and graduate debt, if they're equal, you're going to be paying like equal dollar amounts of the principal balance, original principal balance, you'll be paying 7.5% of your income. If you have more undergrad debt than graduate debt, original principal balance, you'll be paying closer to 5. If you have more graduate debt than undergrad debt, original principal balance, you'll be paying closer to 10. So somewhere between 5 and 10%, depending on how much undergrad debt and how much graduate debt you took out. So generally more affordable. It's going to cut in half about most borrowers' monthly payments, even just that $225 change, which will be applicable to anyone, regardless of the type of debt you have. The plan is also going to address a lot of longstanding issues. So they're going to basically, negative amortization basically won't be a problem going forward because this SAVE plan is going to, on a rolling basis, cancel any unpaid interest that accrues, right? So if your low or no dollar payment doesn't cover the interest, that interest isn't going to sit on your account and accrue. It's just going to go away, which is fantastic. Also, under the SAVE plan, if you're a married borrower who files separately, on the other plans, you have to report your spouse's income. Under the SAVE plan, you're not going to have to report the spouse's income, so that'll lower the AGI that you're using to calculate the discretionary income. Also, I said that you have to affirmatively enroll in these plans. That is true, but they're going to eventually roll out a component of the SAVE plan where if you're delinquent 75 days, they will auto-enroll you if you have pre-approval for them to pull IRS information for your income so they can figure out what to charge you. And then there's a concept called consolidation that we'll talk about, which is basically where you are refinancing within the federal student loan landscape. You're taking out a new federal student loan and paying off your old federal student loan. It is a new loan, and because of that, historically, the clock under 20 and 25 years of cancellation resets. Under the SAVE plan, you will get credit for pre-consolidation time. So if you consolidate your loans and you have time towards IDR cancellation on them, normally that would reset to 0. Under this plan, you will get some amount of credit for that pre-consolidation time. Again, it's a weighted average. So if you're consolidating some loans together that have different times, it'll take a weighted average of how much credit you should have. If that's not the case, or if it's 2 loans that have been in existence for the same amount of time and have the same IDR credit, the resulting consolidated loan will have that much credit towards cancellation. Some more on SAVE. And I should say here, some of these have asterisks. Those are for things that are going to be implemented immediately. Everything else is going to be effective as of July 2024. So the 225 federal poverty line, immediately effective, but not the 5%. That's going to be for next summer. Covering the interest that accrues, immediately effective. Married filing separately, immediately effective. Everything else will be next summer. Additional features of this are undergrad debt. If you have only undergrad debt and it's up to $12,000, the original principal balance, you'll be getting that 5% benefit, which is great, but you'll also get your debt canceled after only 10 years, which is 120 payments, as opposed to waiting for that 20-year horizon. And if you have more than $12,000, they'll add another 12 payments, another year for every additional $1,000 of undergrad debt that you have, up to 20 years, or if you have a combination again of grad and undergrad, it'll be 25 years. So again, this is just a cancellation a little bit faster is another way to think of it for undergraduate debt under the SAVE plan. You normally have to be enrolled in the SAVE plan to get credit towards IDR cancellation, like I said, but this new plan will count certain times in deferment and forbearance. Those are periods of non-payment that you opt into. And they're going to roll out a program where if you historically didn't enroll because you didn't know to or whatever, you weren't enrolled in SAVE or an IDR plan, they will let you buy back, make a current payment in lieu of having made it in the past to get credit for that time that you missed. So I mentioned that they're converting this. Repay is one of those 4 plans I introduced in the beginning of this. They're going to phase it out and SAVE is going to replace it. So anyone in Repay will be moved into SAVE and eventually Repay will no longer appear as an option that you can select. And again, this will be fully implemented by next summer. Okay, so for actually getting into IDR, how do you do this, right? So you can do an online application or you can do a paper application.
And Winston?
Yeah.
Maybe I wanted to find just a time to pause so we didn't get too much time that goes by before a couple of IDR related questions. Sure. I think you may cover some of these, but I want to put them out there so you're aware of them and we'll come to them. So first we have Ash asking the question that I think you're getting to. How does somebody show their servicer if they're going through financial hardship, if that's something they need to show, or how do they sign up for IDR? So you're covering that. That's great. Jose asks if the IDR payment, is the IDR payment calculated based on what's filed in taxes? And you covered a little bit on taxes in the new SAVE plan, or household size in general if a person files taxes singly. So making sure we cover that how you fill your income and based on how you file taxes question. The third from Ivania, and I'm sorry, Winston, I can come back to these and remind you, is do you have a sense when the SAVE payment plan will show up in the loan simulator? A great question. And then credit for pre-consolidation time. Do you have to do the consolidation by the end of this year? Is there a deadline? So if loan A has 50 months of credit and loan B has 70 months of credit, it'll be a weighted average in between. So something on consolidation and how you kind of cover that.
Right. So to sort of run through some of these, generally the way that you show your income, and this is like perfect timing because it's also the best way to apply for these plans, is online through studentaid.gov. You can apply online for your IDR and you can give them permission through that online application. It takes about 10 minutes to do, to go pull your most recent IRS tax filing. So if you're someone who is a regular tax filer, that is the best way to do it. If you're someone whose income is low and you don't file taxes, there's an option to say, I'm not, my income is sufficiently low that I don't file taxes, and they will count that. If you have unusual income or your income has changed since you last filed taxes, you can submit pay stubs, you can submit sort of traditional income documentation, and they may follow up and ask for more records, but in general, recent pay stubs is sufficient. I should also say, and I think this is on a slide coming up, but you can recertify at any point. So if you are employed and you paid your taxes and then a month later you lose your job and you're like, yikes, like I can't make these payments anymore, you can recertify immediately as having zero income as you're unemployed and then get that $0 payment. And then you don't have to recertify for another 12 months. So if your circumstances change again, you don't have to recertify. You only have to recertify 12 months later. So you can enjoy the benefit of that lower payment, even if your circumstances have changed. So in terms of how to document your income, again, taxes is easiest, and however you file, it will be reflected because you're giving them the authority to pull from the IRS if you do it online. And if you don't use your taxes, or that's complicated for some reason, you can submit supporting documentation like pay stubs, like W-2s, or other things that you would typically use. And the same is true for on paper, right? You can either give them permission or you can provide supplemental documentation about your income situation. I don't know when they're going to add it to the online simulator. Things have been, the federal government's budget for this work has been sort of slashed, is the best way to think of it. So they're rolling things out as quickly as they can. So I don't know when they will update that to reflect when that calculation is available. Hopefully it is soon, but folks should be able to receive the benefits of this as soon as they go into effect. So again, if you're already in repay, you will automatically be moved to save. So if you're trying to go online and you don't see save, you can just enroll in repay, and then they will put you into save as soon as it becomes available. And then were there any, did I miss something that wasn't, that someone had asked, Jacob? Did I hit most of those points?
But we had a related question that's a little more specific come in. So for if someone's married and filing jointly, and there's a parent loan just under one of those two people in the couple, can the income be considered from employee letter or pay stubs instead of joint AGI?
So
and from Milagro, sorry, go ahead.
Right, one complicating factor, which I was going to get to in the next slide, is that or maybe it was on the last slide, I didn't read it out, is parent plus loans are not eligible for SAVE. They are the only loan type not eligible for SAVE, and it's hugely problematic, and there will probably be litigation around that, but for the time being, that is the case. And so in general, parent plus loans, this is a little convoluted, it's very specific to parent plus loans. They are not directly eligible for any IDRs. They have to first consolidate to be a consolidation direct loan, and then they're eligible for only the ICR plan, which is the most expensive of all the plans. So parent plus loan counseling is sort of its own thing because of all those factors. So that, and I believe under ICR, I don't think that there is, I think it's just household income. I'd have to, double check that. A lot of these details are things that in practice, I used to be a legal services attorney and did legal aid counseling for student loans. You just always have to double check all these things, right? Because the plans are very similar, but a little bit different from each other. So in terms of figuring out on one plan versus another, is it married, filing separately, jointly, whose do you count? It's always a good idea to double check. So I don't remember off the top of my head whether ICR, the one plan eligible for Parent Plus loans once they consolidate, how you would handle that in this circumstance. But just to underscore, the SAVE plan, Parent Plus loan borrowers are not eligible for, which is, again, hugely problematic, but not going to get resolved in this webinar, unfortunately.
Great, Winston. Thank you so much. You're go right ahead back to the
Okay.
presentation.
No, and so just to wrap up on IDR again, I would recommend you do it the online application. It's easy. You get confirmations. You can also do it by mail. Currently, you can even do verbal IDR certification where you can call the servicer if you can get through to them and request to be put on one of the IDR plans and just verbally tell them your income. We're hearing mixed results about how that goes. People who say they requested it, but then there's not a paper trail, so they're not getting into it. And because their loans are paused right now, they don't know, they haven't seen the effect of it until their payment plans start. So we would recommend doing the online application if it's at all possible, but the phone is also an option. When you fill out the application online or in paper, there is an option to just be put on the most affordable plan. Again, for most people, that'll be repay/save if they're eligible for it. But if you're not sure and you can't figure out yourself which one to do, there is that option if your goal is pure affordability. Okay, and then so something to keep in mind, and I should say also that IDR recertification during the payment pause has been bumped out, so no one needs to be recertifying right now unless they think their income is lower than it was the last time they certified and they want to take advantage of that lower income currently and get a year out of it. But in general, you have to recertify every year. It's good to set an alarm. You'll get a notice, but you just want to be very proactive about it. You can certify more than once a year. I mentioned if your income changes, there's no obligation to certify again if your income goes up. I would recommend against that. Keep that lower income based payment for as long as you can until you have to recertify. Easy to do online, takes a couple of weeks to process. And if you're consolidating your loan, which we'll talk about in the next few slides, you can elect to have an IDR plan through that process itself. You don't have to do two different things. Okay, so that's payment plans, but let's say that's just not working for you or something else happens and you find yourself in default. What can we do? So first, what does it mean to be in default on a federal student loan? Technically, it means that you are more than 270 days delinquent. There is a long runway in the federal student loan world for being considered in default. And while you're delinquent, you still have access to the payment plans. You can catch up, you can get into a forbearance. Once you're in default, the circumstances change a little bit. When you're in default, the federal government, without going to court, can garnish your wages, can offset your tax, your Social Security and tax benefits, and will negatively report on your credit, furnish negative data to your credit reporting agencies. They do send you a letter and an opportunity to sort of raise any defenses before they start garnishing and offsetting, but unfortunately, affordability is not a defense. There has to have been something that is more of a legal defense. So once you're at that stage, you should be thinking about how to get out of default and avoid all of these things. So the federal loan, there's really two main ways to get out of default. You can do something called consolidation, which we'll talk about right now. You can consolidate your way out of it, or you can rehabilitate, which is a slightly longer process. There are pros and cons to both. You see, and you're not supposed to digest this map, but it's just there for visual effect. Like rehabilitation is on the left there, consolidation is on the right there. Consolidation is a much more streamlined, fast way to do this. But we will talk about each of them over the next two slides. So consolidation, I mentioned it once already. It is that process, or I guess I'll sort of leave here for a second as I say this. It's the process of refinancing within the federal government. It is, you're taking out a new federal loan to pay off and pay down your existing federal loan or loans, right? And so, just going to the next slide. So the way that gets you out of default here is you're paying off a defaulted loan and replacing it with a loan that's in good standing because it's brand new. So the application can be done online, also in paper, but online, it's pretty quick. You can select what your next payment plan will be and if you're coming out of default, doing it into an IDR plan and figuring out what's going to be affordable there. Now, it does not remove any of your negative credit reporting because that happened and you're just taking out a new loan and paying it off. It's also a relatively quick process to get approved for. There's usually just about a month's turnaround after you complete the application. There's a letter that comes about 2 weeks after you apply that says you've been approved for this or you applied for this. Like if you don't cancel it right now, it's going to go through. In most instances, you don't want to cancel, but it's basically just the last time that you can say, actually, my circumstances have changed, or I didn't understand something, and yes, I would like to cancel my consolidation. So the benefits there are speed and getting straight into an IDR plan. And once you're back in good standing, you get access to a lot of things that are frozen when you're in default. Like if you need to take out more federal financial aid to finish your degree or something, you can't do that while you're in default. If you're subject to wage garnishments or offsets, that ends much sooner. But then the trade-off is that you keep that credit reporting history. Also, historically, as I mentioned, when you consolidate, because it's a new loan, you lose all the credit on your loan towards cancellation under IDR, the 2025 year horizon, and under similar programs. But as I also mentioned, they've taken steps to reduce that with the weighted average component. And then there are some special time sensitive opportunities that completely reduce that, and you can keep all of your credit, which we'll talk about. So that's consolidation. Rehabilitation is a slightly longer way. What you do is over a 10-month period, you make at least 9 on-time payments. They have to be at least $5. They cannot be involuntary payments. If you're being garnished, that doesn't count. But when they're figuring out what the affordable payment that you can make in, they do take expenses into account, which is unusual. I mentioned earlier, it's usually just how much you owe. So it's a slightly different process, but when you're rehabilitated, they remove the default status from your credit history. So after that's processed, your credit history won't show that you had been in default, which is a good thing. You can only rehab, or I think this is on the next slide, so I'll say this. You can only successfully rehab once, which is a pro and con there. So as I said, you can only rehabilitate once. It takes a little bit longer. So for some people who don't want to be subject to garnishment for 9 or 10 months, consolidating is faster. Some considerations about consolidation is that you generally need to have, as the name suggests, more than one loan that you're consolidating together. The one time that's not true is if you have a single older loan type, that FEL type that I mentioned. You can convert it to a direct loan through the consolidation process. So although it's a one-to-one there, it's from one program to another, so that is permitted. But once you're in that direct consolidation loan, if it's the only loan you have, you can't then consolidate again. So with direct loans, you can consolidate as many times as you have individual loans. So if you have 3 loans and you consolidate 2 of them together, you can then later in time consolidate that consolidated loan with the single loan that exists. But once you do that, you only have 1 loan left. And so you can't consolidate another time. So again, there are some strategies. If you've already rehabilitated, you can consolidate out. You can consolidate out just because you need relief faster. It really depends on the individual circumstances of your client or the person that you're speaking to. And again, once you're in default, a lot of the activity is going to be run through a special default servicer. Your account will get moved over and you can access a lot of the information you need from myeddebt.ed.gov, which is on here. And you can sort of negotiate with them about what the best option is for you. Okay, so that is generally the 2 ways that you get out of default. Currently, however, there's a program called Fresh Start, which is specifically for folks who have been in default. It restores your repayment and federal financial aid eligibility to borrowers. I mentioned that when you're in default, all of that is frozen, but it puts you back in good standing. It's not going to count as your one successful rehabilitation. It does have the credit history fix benefits that rehabilitation typically does. And it'll stop that involuntary collection of garnishment and offsets. So again, it's basically moving you back to good standing through a different process than the consolidation rehab options would have been. It's only eligible for certain loan types, and these are people who were in default before the payment pause started in March of 2020. That is because during the payment pause, anyone who defaulted basically gets put into good standing automatically anyway. So it's not like it's oh, tough, you've defaulted since then. You have no options. It's that you're not experiencing the negative parts of default and you've already been restored to good standing. So it's only for people who predate COVID, and so the pause wasn't an option for them, as their default wasn't related to COVID. And it's eligible for, again, here's where the loan types that we talked about in the beginning come into effect. All the direct loans, both types of FEL loans, both the ed held and the commercially held, and ed held Perkins loans, right? So here's, I guess this basically leaves out school held Perkins loans. Now, the way that you, here's where you see the ineligible types. Again, there are some discrete loan types that we didn't really talk about because they're not as common. So to get into it, you have to take one of two affirmative steps. You either have to communicate to the servicer, the default servicer that has your loan, and say you want to take advantage of Fresh Start. Please put me onto a payment plan. Let's get back into good standing. Or you have to request federal financial aid to go back to school, and that process will trigger your Fresh Start benefits, and your defaulted loans will get put back in good standing. If you don't do either of these things, you will basically just end up back in default, or stay in default as it would be. So as it stands today, you can rehab or consult, or after the payment pause more effectively is over, you can rehab or consolidate out of default depending on your circumstances, or for this one time only, you can benefit from Fresh Start and get out through Fresh Start and sort of preserve your loan history as it has been. Okay. So we've talked about repayment options. We've talked about how to get out of default. Now we're going to talk about cancellation and forgiveness. Unless, Jacob, you think we should pause here and flag any questions in real time.
Yeah, let me just make sure. There have been a couple questions. I think maybe some of them have been covered, but let me double check. Okay. So first of all, I want to thank Ivania, who shared some more information in the chat on sort of things to know about marriage and filing jointly versus separately from studentaid.gov, which is great. Will consolidating my loans affect my PSLF eligibility? I told Maria, who posed that question, that you'll be walking through PSLF extensively, but I'll note that that was a question there. And then a question from Mariette, could you please confirm if the Fresh Start can be applicable if the loan is already with a collection agency? I apologize if I missed that you covered that specifically. And I think those were the questions we caught up on.
Right. So I think the last one is the only one that won't be covered going forward. So I'll just answer that, which is that if you're with a collection agency, it's a federal student loan, they can benefit from Fresh Start. So this is exactly who that population is meant to help. So if you communicate with them and say you want to benefit from Fresh Start, that should be all it needs to be. But again, this is just for federal student loans. So if it's the private loan that's with a private collection agency, unfortunately, this is not available for them. And then the PSLF question we will get to in the next coming slides when we talk about PSLF, and then some of the update slides that come after that, because there are some changes to the programs that touch on that question. Okay, and thank you, folks, and keep it coming. Okay, so there are, in addition to repayment plans, and we talked about IDR as both a repayment plan and a debt cancellation plan, there are a number of programs in the federal in the Higher Education Act, which is what creates the federal student aid system, that allow for debt cancellation or discharge of debts. I'm just going to sort of voice over a couple of them as we click over them. Again, the purpose is not to make you an expert in any one of them on this call. The purpose is to make sure you know that they exist. So if you're doing an intake or talking about screening, you know to think or ask about these things, or if a client brings it up, it triggers something, and then you can go and figure out whether it's applicable for this person. So, and I've sort of bucketed them, tried to bucket them together. So you can think about these as like school-based discharge. One is called borrower defense to repayment. If someone took out federal financial aid to attend a school that defrauded them or lied to them or somehow made a misrepresentation to them. The standard for this has changed a little bit over time, but the general idea is the school overpromised, underdelivered in a like a fraudulent manner. You can get your federal financial aid discharged, your loans discharged through that, and Pell eligibility restored that were used to attend that school. This is often for-profit schools. You probably read about this a lot in the news over the last few years, Corinthian colleges, ITT Tech, that kind of thing. There's also something called closed school discharge. If you are enrolled at a school and it closed, or you recently finished at the school and it closed, you can also have your debt canceled from that school. It's not always that clean cut. It depends on whether or not you took what's called a teach out option, which doesn't usually happen. But if you were able to successfully move over to another school that's designated as the sort of successor school for students, and you finish your school there, you're not eligible for this because you got the benefit of the education you were seeking, is the idea. But in general, you can get your debt canceled if you fall into the correct windows of time around when the school closed. They're moving to automate this and just have some new rules that went into effect on the 1st of this month. that are getting implemented. So it's better, but again, the idea is screening for someone who attended a school and it closed around the time of their attendance. False certification is if someone basically, if you shouldn't have been able to take out loans to go, you didn't have a GED, for example, in the school, or someone else falsely certified that you did and that you were eligible to attend, or you don't speak any English or something and the courses are only taught in English, you can get your loans discharged that way. An unpaid refund, if for some reason you drop out and your federal financial aid should have been returned to the federal government and it wasn't for some reason, that's not on you. You can get those discharged as well because you didn't actually attend school using the money that you had taken out to do that. So these are, again, loosely school-based discharge. Another bucket is sort of like circumstance-based discharge. So we've talked about income-driven repayment plans. Those are lower income payment plans for a long period of time. You can get your debt canceled. There's also one called total and permanent disability, or TPD discharge. If you were living with a total and permanent disability that prevents you from working and making an income, you can get your debts canceled. The program has been improved in recent years too. There used to be a look back to make sure that you're not sort of making money after your debt's canceled and that you truly couldn't hold down a job. That has gone away. You can document this either showing SSD or disability benefits, or having a physician sign a form that basically says you're living with a severe disability that prevents you from working. Again, there's a particular definition of what qualifies you, but the idea is if you have folks who are on disability or living with a severe disability, they may be able to have their federal student aid loans discharged on that basis. Another bucket are like employment-based discharge or service-based discharge. If you're a teacher or work for a nonprofit or for the government under public service loan forgiveness, you can have your debts canceled after a certain period of work and payments during that time, and the remainder will be canceled. I'm going to spend one slide on that PSLF public service loan forgiveness program specifically, more as an example to show you that there are eligibility requirements for each of these programs, and there's sort of too much to list for all of them right now, but they're pretty well spelled out on studentaid.gov, which is the federal government's main website for all of this stuff. But for public service loan forgiveness, for instance, in general, in normal times, the eligibility requirements are you have to have a direct loan. Again, there's other loan types. If you don't have a direct loan, you can consolidate to make a direct loan. There was that great question about when you do that, do you have to restart on this? And I'll get to that. But you have to have a direct loan. You have to be making a payment plan under the correct repayment plan, or make a payment under the correct repayment plan, which for most people is going to be one of the IDR plans. Any of them will count. There are some other ones that are eligible, but for most people, it is IDR. You have to have the right kind of employment, which is full-time employment for a public service employer, government, 501c3 nonprofit, or certain other nonprofits. And you have to be there full-time, which means at least an average of 30 hours a week. And again, there's some nuance around that as well, but this is the 50,000 foot level. And then you have to make 120 or 10 years worth of payments. It can be non-consecutive. You can take time off, switch employers to an ineligible employer, come back to an eligible employer, et cetera. And it's just cumulatively, you have to have 10 years worth or 120 monthly payments when all of these factors are true. You have the right loan, the right payment plan, the right kind of job. We will talk in a couple slides about recent improvements to make that whole process easier and don't penalize you if you didn't do something correctly at a certain period in time and got sort of sent in the wrong direction. There's a way to correct course for that right now, which is good. But this is the general PSLF criteria. And then the last bucket of discharges are bankruptcy. So there's this idea that federal student loans can't get discharged in bankruptcy. It's actually just that they're harder to discharge in bankruptcy, not that they cannot be, and same with private student loans. So it's possible to do it. It has just been historically harder. There's a higher threshold to prove. The federal government, and that's, judges have made that decision. So the Department of Education can't change that. It's in law and it's in how the law has been interpreted by courts. But the Department of Justice under the Biden administration did come out with a new memo basically saying, we aren't going to oppose discharge by the bankruptcy judge in certain instances, and making it clearer and easier for folks to do that when it really should be discharged along with their other consumer debts. That is for federal student loans. Private student loans are out of their jurisdiction, but it is still making it easier. It's been less than a year since this happened, but we're already seeing more people get discharged, have their debt discharged in bankruptcy. Another thing to note about this is that higher threshold for getting debts discharged in bankruptcy is very specific to what's called a qualified education loan, which is any federal student loan, but also loans, private student loans that went to like accredited schools for actual cost of attendance, like really a specific loan type. loans that you take out as a student aren't necessarily student loans, is the point I'm making. And so there are a whole type of loans that people take out either to support themselves, but not actually cover tuition, or to cover tuition, but at a school that wasn't accredited, or whatever the case may be. Those are not those special loans that are harder to discharge. Those should be discharged generally. In the CFPB, the Federal Consumer Financial Protection Bureau recently went after a company for continuing to collect on those other types of loans that were discharged by bankruptcy judges, but this company treated them as if they were the higher threshold type of loan and pretended that they hadn't been discharged and still collected on them. So don't just see the word student loan or the fact that someone was a student and assume it's harder to discharge. There's actually some variation in there as well. Okay. So I've made a couple references during the payment plans and during PSLF and IDR to like changes in some of those things. So I'm just going to talk about a couple of them really quickly. The CARES Act and the payment pause and return to repayment, Biden's student debt cancellation, which you probably read about in the news, the IDR repayment plan updates that I've referenced, and then sort of some upcoming regulatory changes. And then we're going to quickly hit issue spotters and be done and have 45 minutes to talk through or answer any more questions, if not more. So this is probably something you've all experienced yourselves or are aware of at this point, but since COVID began, there's been a pause on federal student loan payments. It's been about 3.5 years. During that time, there's been no interest accrual, no involuntary collections like wage garnishments or offsets of Treasury benefits. And all of those months of the pause count towards the 20 or 25 years for IDR or the 10 years for PSLF, which makes sense because if you're not being required to make payments, they don't want to penalize you on your progress towards a payment plan based cancellation, right? So as long as you maintain eligibility otherwise for those programs, like you have the right job for PSLF and you have a direct loan, those months will count. That's ending in September. So interest will start to accrue on September 1 and payments will start to be due starting in October. Folks will get notices. It's a rolling start date. So it's not like October 1, everyone has something due. And recertification for IDR will follow. Folks will get notices, but again, you can always affirmatively go and recertify if your income changed or if you want to get into repay so that you get moved over to save or just move yourself over to save, you can do that. We have a note here that just based on the fact that people go to college and they take out more debt and it's been 3.5 years, almost 1 in 5 borrowers have probably never made a payment on their loan just because their loans have been in the payment pause for the entirety of their repayment period. So we can expect there'll be a lot of confusion from folks who've never navigated this before. Okay, President Biden's debt cancellation program. Somehow we're only doing one slide on it, but it's, as you'll see, there's sort of not much more to say about this. But last year they announced a debt cancellation program, $10,000 for someone who meet the income cutoffs, and an additional 10 if that person also received a Pell Grant, which is a grant, not a loan, from the federal government based on coming from a low-income household. The income cutoffs were $125,000 for an individual, $250,000 for a household, based on either 2020 or 21 tax year declared income. It was application based, very easy, almost Google form style application, self-attestation to your income, super simple. About 40 million people were deemed eligible based on their income, estimated, I should say, not deemed, estimated eligible. In the only 10 weeks the application was open before litigation shut it down, about 20 million people affirmatively applied. So that's like an amazing uptick, right? In just the first 2 months of a 12-month application window, half the eligible population applied. Of that, about 16 million were processed and deemed approved, but didn't have their debts canceled. And the remaining few million just weren't processed yet because, as you're likely aware, a couple of people sued. Two of those cases made their way up to the Supreme Court. And just 2 weeks ago, on the basis of a lawsuit by 6 state attorneys general, Republican state attorneys general, the Supreme Court found that Biden didn't have the authority to do this program, or the authority he claimed he had didn't support the program. So that's 2 weeks ago tomorrow is when that happened. The whole program had been kept on ice for that over 7 months while it made its way up through the court system. And as it stands right now, those loans are not being discharged. On the same day, the president announced that he's going to engage in a rulemaking process to get a similar or the same outcome, but through different authorities. And he feels that it will be more litigation proof if he goes through like a rulemaking as opposed to using executive action. without opining one way or the other on whether that's correct. That's what he announced. And so there's going to be, there's a deadline next week for people to submit comments about it. All summer we'll hear more about it, into the fall when the rulemaking takes place. But we have to wait and see what else happens. Critically, this debt relief process is only about that $10,000 or $20,000 cancellation. It does not affect any other federal student loan programs, cancellation, repayment options, etc. So nothing we've talked about in the last hour is affected by the Supreme Court ruling or the rulemaking, except for what is on this slide. So people are still eligible for all the other things we talked about, including the SAVE plan, including public service loan forgiveness, all of that stuff, fair game. So again, this is one slide because there's actually not much to say about it as of today relative to 2 weeks ago, but the rest of this presentation holds true. So the income-driven repayment plan, this addresses two of the questions that have been asked already. So I've talked about how you have to have progress towards 20 or 25 years for cancellation under income-driven repayment plan, and you have to have been enrolled for each of those months during that time period in an IDR plan. And if you consolidate your loan, you reset the clock, or if you don't recertify and you get dropped out of the plan, those months won't count, etc. There is a long history of those servicers from the first couple slides not properly explaining this plan to people and steering them away from it. So last year, the government announced, like, we recognize that this program hasn't been accomplishing what it set out to do. At the time, there was a stat that there were about 4 million people who had been in repayment or had loans that were at least 20 years old. And so you'd think would have reached, some of them would have reached cancellation, but only 37 of them had cancellation under IDR. Like, clearly something was not working. So basically what the federal government is doing right now is they are auditing everyone's accounts, and they're giving time towards IDR, towards that 20-25 year cancellation, for any month that anyone's loan was in repayment, or no matter what repayment plan it was, or certain forbearance and deferment periods. All of that time will count towards IDR cancellation, even if you weren't actually in IDR. Critically, they are also going to count any time before you consolidated. So if you consolidated at some point in the past, or anytime before December 31st of this year, they will count the pre-consolidation or pre-multiple consolidations. If you've had multiple, they will go back to the very beginning until like 1994, I think, and count all that time up and add it to your account. If you are someone for whom that adds up to 20 or 25 years worth, your debts will be canceled. If you are not someone who is quite at that point, you will keep that credit on your account, and then you can, going forward, affirmatively enroll in IDR and keep getting credits going forward until you do hit cancellation or something else happens. To benefit from this, it's going to be automatic for any ed-held loans. Remember that couple of first slides, that table, the left-hand side, all direct loans, ed-held FEL, ed-held Perkins. All of those will be automatically eligible and will get this automatically. If you are a commercially, privately owned FEL or Perkins loan borrower, you have to consolidate your loan by the end of this calendar year. You'll become a direct loan, which will put you in the Department of Education's portfolio, and then you'll get the benefit once you do that. They're going to run this algorithm, do the audit at some point next year. So people, if they consolidate now, it will look as if they're resetting their clock, they're resetting their counter, and that's very alarming, but it is okay, it is normal, because they will get that pre-consolidation time at some point next year. They're not doing this on a rolling basis. For the most part, they are just going to run the algorithm overnight or over a week or two, and they'll add back in credit to people's accounts after the fact. So you will get your credit back from pre-consolidation as an example, but it won't be immediate. Now, because IDR time counts as a payment plan for PSLF, these audited months that you're getting back will count towards public service loan forgiveness as well, right? So the same thing is true as long as you have documented your employment with the federal government, which you have to do. It's a simple form. They don't know where you work unless you tell them. They are the Department of Education. They are not labor. They are not the IRS. So they don't know where you're working until you tell them. Once you match up that employment time with your payment plan time through this adjustment or otherwise, they will then give you your PSLF credit. And if it's 10 years, it'll be canceled. If it's not 10 years, you will continue to work towards it and keep picking IDR plans or certifying whatever you need to do. Now, the one note here is the IDR account adjustment will be automatic for all ed-held loans, FEL and direct loans. But for PSLF, you need to have a direct loan, right? So if you have a FEL loan, you might get the IDR account adjustment, which is what this audit is called, but you can't get your PSLF unless you consolidate to get into a direct loan. And if you don't do that by December 31st of this year, if you do it later, you will lose that benefit of pre-consolidation time when you make the change. So if you have an ed-held non-direct loan and you want public service loan forgiveness, you need to consolidate by the end of the year in order to get the benefit of all these pieces coming together. And it is a lot of moving pieces coming together, and it's a little bit head spinning, frankly. But if you can navigate it, it can be a great benefit to your clients. Okay, just basically one slide on private student loans, because there's unfortunately not much to say about them. They are, as I mentioned, governed mostly by state law, a little bit by federal law, and then the whims of the private lender that made the loans, right? And I should say, we're really almost done with me talking, about 3 or 4 more minutes, and then we can open it up and answer more questions. So private student loans, I mentioned it's 270 days of delinquency until default for a federal student loan. For private student loans, it's whatever is in the contract. So it could be 1 month of missed payments, it could be 6 months of missed payments. It really depends. And there are no required ways to get out of default for a private student loan. It's really about what you can negotiate with your debt collector or the lender, monthly payment plan, lump sum, etc. A private student lender does have to go to court to get a judgment against you before they can garnish your wages or freeze your bank account, unlike the federal government. So there is the court process there, although that's not fun for anyone. There's really only 2 ways to get out of paying your private student loan. One is if they let the statute of limitations run, right? You haven't made payments, they don't sue you in time, they can't then go to court to sue you, and so your loan will no longer be enforceable. The other is similar to that program for the federal student loans. If your school defrauded you, I said you can get your debts canceled. Using litigation, if your school defrauded you, you can also not have to pay your private student loans, but it's not an application process. You would have to sort of be sued and then use that as a defense. So it isn't ideal, but it is still an option there for private student loans. So again, unfortunately, not much to say about this, because there's not a one-size-fits-all set of recommendations other than sort of negotiating where you can. Okay, very briefly, we're going to issue spot. Like, let's say you've digested some of this, you rewatched the recording, you have the slide decks, you're feeling like okay about this level of information that we've just sort of like inundated you with. And then you start to meet with clients, right? What are some things to keep in mind? First of all, people might walk in the door to work with you and not think they're there to work on their student loans, period. So like asking if someone has student loan debt can be very helpful, because they might not think they have options for it. They might not think it's worth it. They might have something they consider to be more pressing, and maybe it is more pressing, but you still want to deal with the student loan at some point. So just being affirmative and asking about that is important. But then there's that really complicated question of what kind of loans do you have, right? And for reasons I mentioned about the same servicer servicing both, and just the fact that it's confusing, someone might not know. But if you go to studentaid.gov, which I've referenced a few times, and if they don't have a login, they help them make a login and log in with them. All of their federal student loans will be listed there. Any federal student loan they have, including ones that have been paid off and have a $0 balance, will show up on studentaid.gov. So that is the universe of student loans, even if they're privately held student loans. All of them will show up. And there'll be information for each of them about who the servicer is, and if it's not the Department of Education who owns it, who does own it, etc. If you want to know if someone has private student loans, the only place to really check, unless they know they have a login for a private student loan company, is their credit report, right? Because it'll be furnished as an account there. And you can compare that to the federal student loans and see any that appear on both. Federal student loans, if they only appear on a credit report, probably a private student loan. You also want to figure out how much they owe. This also seems like a pretty straightforward question, but people don't always know. Now, it's worth asking if they recognize the loans, because it happens. People get loans taken out, identity theft, false certification, all those things I mentioned. Just confirming that they're like, yeah, I did go to that school, or yeah, I did take out a loan, is worth asking, because it will send you in a different direction if the answer is no, and if that's accurate. And then the status of the loans, right? Are we dealing with a loan that is in repayment and they're paying it? And do they want a more affordable plan? Are they good where they are? Are we dealing with a loan that's delinquent but not yet defaulted? Let's get them back, get into an IDR plan if the federal loan, et cetera. Call the servicer for a private loan and figure out what their options are. Are they in default, right? And we're going to talk more about this on the next slide. And then it is always worth asking too. Some people think about their loans as totally separate from their education, but ask just a quick probing question about their school experience, because if they got defrauded by their school, that's also going to send you in a totally different direction for how to get this debt discharged than it is if they're like, yeah, I graduated, I got exactly what I signed up for, the education quality was good, et cetera. It's not like you hear these horror stories about for-profit schools as an example, where they were told, great student to teacher ratio, and then it ends up that it's like 40 students and like a 1 year ahead of them student is the instructor, right? And like great career services, and the career services is just Craigslist, right? Like that kind of stuff. That's the kind of details you want to get because maybe they got defrauded. Okay, now for federal student loans specifically, again, figure out who owns the loan. Is it the federal government or is it a private lender, a commercial lender? Again, you can see this on studentaid.gov. If you see a list of loans, it'll say US Department of Ed, or it won't. And if it doesn't say US Department of Ed for that individual loan, when you drill down into it off their login, it'll say like US Bancorp or Wells Fargo or whoever it is that originally had it or who currently owns it. But if it says US Department of Ed, and then next to both of those, whoever it is, it'll have a slash, and that'll say who the servicer is. That's how you can tell that. Again, if they are current, making sure just, they feel okay about their monthly payments. If they're delinquent, get them into an affordable payment plan, or think about discharging their debt, but keep them from default. If they're defaulted, again, think about those: rehabilitation, consolidation, fresh start. Do they want to consider bankruptcy? And then talking a bit about what their goals are, right? Are they someone who's working towards public service loan forgiveness? They need to get that 10 years. Are they someone who just really needs monthly affordability? That is their goal, and it doesn't, they're okay with being on a long repayment plan as long as it's affordable. So just figuring out what their goals are and which plans match up with that, and trying to always screen for whether they can get their debt discharged. And then, because there's different eligibility for all these programs, making sure you know not just who owns the loan, but what type of loan it is, and whether or not you need to consolidate to get them into the right plan to benefit from whatever your plan and goal is for them. And then similarly, like just figure out their school experience, figure out their lender experience, if there's anything that makes them eligible for a discharge on the basis of having been defrauded, or are they part of a class of people who should already have their debt discharged because there was a class action, or because there was a closed school discharge that was automatic, and just making sure that they shouldn't have been covered already, and that you don't have to do something yourself. Now for private student loans, again, it's that how much do they owe, who do they owe it to? It's worth asking about their experience with the lender and the school, because if there was predatory lending or a predatory school, there's ways to avoid having to repay it. I'm sort of being repetitive, but I think it's helpful here. If they're defaulted, see if they've been sued. They might not know if they've been sued, so check the court system. You can usually search defendants by last name, see if there's a judgment, et cetera. There's unfortunately lots of instances of what's called sewer service, where you didn't get served, and so you miss the whole court experience, and they get a default judgment against you, and you only find out because your bank is suddenly frozen, right? And then you're in a crisis. Ask about the lender in school for all the same reasons. Consider bankruptcy, right? Some of these may end up being a handoff to a legal services partner, and that's totally fine. You're sort of just screening to figure out whether there might be a legal issue to make sure this person gets the help that they need. So what are some resources? Studentaid.gov is that website I mentioned a lot. That's the US Department of Education. They also have an office of the ombudsperson, and this is a really great resource. You can file a complaint with them and they'll escalate issues. This can be eligibility issues for programs that you think you should qualify for, but you're being rejected for, servicer issues, really anything with your federal student loan. You can file a complaint with the office of the ombudsman. CandleMaStudentDebt.org is a website that the Student Borrower Protection Center monitors and maintains, and it has information about IDR and PSLF and Biden's cancellation and sort of the hot issues right now. It doesn't have as much information about the discrete discharge programs, but the next website, StudentLoanBorrowerAssistance.org, which is run by the National Consumer Law Center, is a fantastic resource and has much more of the program-specific information that you might want. Depending on where you are, there are about 18 states in the country that have or about 15 to 18 that have a student loan ombudsman. It's a state government-based ombudsman who can help with your private or federal student loans and provides educational resources, but also helps you interface with your student loan servicer. They also take complaints. Your state's financial regulator, I should have also said attorney general, either of those two regulatory law enforcement offices take complaints, and they usually have some expertise around student loans. And so they're a resource too, probably more for filing the complaint, but it is helpful to do that. And then finally, the Federal Consumer Financial Protection Bureau, really great complaint resource. They share complaints. So if you're going to file a complaint in one place, I'd say do it with the CFPB. They use that data to do large enforcement mechanisms. The complaint with the CFPB, the company has to respond to them within 30 days. So it's also a good way to like force a response out of a company that you're not getting an answer out of, and it might move them to do whatever it is you've been asking them to do. So the CFPB is a great resource. So my very final slide if you're like, all right, what do I do with this hour and 10 minutes of information, is just think about incorporating screening and intake procedures that can help identify student debt issues for your clients or constituents. Prepare for an increase in demand due to a return to repayment that's happening this October. Think about who might need to consolidate by the end of this year to benefit from that IDR account adjustment. Again, it's any non-federal government held federal loan, or those FFEL loan borrowers whose loans are with the federal government, but they want to access public service loan forgiveness. They need to sort of make sure they take that step by the end of this calendar year. Remember, the new SAVE plan is coming up. People can start by getting into the repay program, and then the other parts of SAVE will come out soon. That's going to be much more affordable for most people. And then just there's been so many changes, just update any materials you have and share them and send people to other resources if that's the best way to do that for your office. So that was a ton of information. The goal was to go 1.5 miles wide and like 2 inches deep, and hopefully we accomplished that. We can follow up on any of these, in the remaining 45 minutes that we have, but also in subsequent trainings or by email, and Jacob and I can push information out to you. So I know that was a ton. I'm going to stop sharing my screen, but hopefully it was also helpful.
Thank you so much, Winston. So we're going to get to opportunities for you all to ask questions. I have a few that are in the queue that I will call out and let people answer, but I thought it was appropriate, given this question of resources and what if you have continuing questions. Adriana had a very good question. Oh, well, now my chat has departed on me. Let me bring that back up again. So Adriana asked, will there be consultation support that staff can tap into should unique issues come up with clients? And my answer was sort of, we're going to talk about it. And yes, to a point. There will be a time, I don't think we're going to press Winston so much as to say, that he's got the special red phone where if you have a question, call him right up, real time. He'll, we would love that, but we just don't, he does a lot of other stuff. So we don't have the time for that. What I would say is the city's partnership program is just going to be a great backbone resource and support. So the city and county folks that you work with, often your Office of Financial Empowerment folks, I know some of them are on the call today. They're regularly in contact with us and are going through these sessions and meetings. And can be a good sounding board. You can also come directly to me. I'm sort of a good sort of facilitator of questions. I may not have the answer for all of them, but I'll at least make sure that we can point you in the right direction, or that we can get somebody to talk with you through it if it's, it's a thorny question. To the extent that you have legal aid relationships in your community, many legal aid, not all, but many legal aid services have some pretty good knowledge and understanding of student debt. But they can certainly help you unwind sort of more complex legal issues. And so that can be another resource. I'll just lastly say we have been testing out holding what we're just calling office hours with the city partnership group on a biweekly basis. I'm not yet ready to open that up universally to everyone. We may either do some separate sort of financial coach office hours and test that out, or maybe we all decide as a group, no, come one, come all. That's a good place to do it. But that's another kind of timely way that we can handle those questions. So thank you, Adriana, for that question. And then before I get to the other questions, I will say, Winston, Mariette, and I'm sure she's reflecting many other people's point of views, this is the most in-depth training I've ever attended about student loans, provided with so much clarity. So thank you. Having said that very quickly, let me go back and let a couple of you who asked some very good questions just repose them to Winston in person. So Milagros, you asked a question about payments that people may have been made during the pandemic, even though they were not required to. Why don't you go ahead and unmute yourself and ask that to make sure you're asking it the way you want to ask it.
Thank you. Yes. Hi, everybody. Customer was making payment during the pandemic, right? And the payment was on hold. So the customer is wondering what's going to happen with those payments that were made. If they were putting into an escrow account or they were applied to principal and interest. So what the service is doing with those payments during the pandemic? If you know the answer.
Yeah, no, it's a great question. So one clarifying point is that the payment pause is only for those Ed held loans, that left-hand side of the table, right? All direct loans, Ed held fell, Ed held Perkins. So if you were a privately held Perkins or fell, you were getting statements, you were making payments this whole time. So assuming they were part of the population that had, but another note, if you consolidated at some point, since when you consolidate, you end up with a direct loan, you put yourself over to the Department of Education. So there were some people who started off not getting the pause, consolidated for one reason or another, and then ended up getting the pause for the remainder of consolidation to now. But let's assume your hypothetical, your client is someone who was getting the payment pause, right? And they were voluntarily making payments. They shouldn't have been having any ACH or any automatic withdrawal. That should have stopped. So that might be an indicator that they were not in fact getting the payment pause if they were involuntarily making payments. But if voluntarily making payments, that is going, payments to the federal government always go first to like fees and interest, and they will go to principal last, right? So if you're current, it's always just a little bit of principal and then interest, or a little bit of interest and then principal, sorry. But someone who's making voluntary payments, if they had gone through any interest that had stacked up and accrued, and so they had no lingering interest on their account, those payments would go entirely to principal. So if you're someone who doesn't plan to get discharged at any point, you plan to repay your loan, the payment pause represents a really good time to just attack your principal. Just cut down your principal as much as possible because there's no interest accruing each month. And then when the payment pause ends, they are probably going to re-amortize, not negatively amortize, but re-amortize to figure out what your new monthly payment should be based on your lower principal. It's a little hard to say in the abstract what that will result for people. It should be lower in theory, but it really depends on individual circumstances. The final thing I'll say about this is if you did make voluntary payments during the payment pause, you can request a refund of those payments. And the reason why that might be a good thing to do for someone is if you do plan to get discharged, you're a public service loan forgiveness candidate and you're 2 years away, you're 1 year away, you're IDR and you're like 18 years, whatever the case may be, you're sort of like, well, I want that money back in my pocket because the whole loan is going to get canceled anyway. So why should I pay towards something that's going to get canceled? Again, when you're in a debt cancellation mindset, you're not as concerned about how much you're paying, you're concerned about hitting the requirements for cancellation. The thing about, so you have to just call your servicer and get a refund if you want to do that, or your client should. The thing about that that's frustrating and is a little complicated is the federal government has sort of changed policy on this, and they are not doing pre-consolidation refunds. So if you were making payments for a year and then you consolidated to take advantage of any of the things that we've talked about here, and you kept making payments or you didn't make payments, either way, you're not going to get a refund for the payments you made during the pause pre-consolidating your loan.
Thanks so much, Winston. And Milagros, feel free to add more to that if you have more to the question.
Thanks,
Thanks, Milagros. Next, Sean Judge, I want to let you ask a couple of quite related questions about payment plans and IDR. If you're with us, Sean, go ahead and hit unmute.
Yeah. Hi, thanks. So for those that are in an IDR payment, because there's so many classifications within IDR, how easy is it to convert to other payments? Is that allowed? And then secondarily, how or which ones of those can be converted to saves if other than repay, which you said is automatically going to convert?
Right. So there's two, and it's a great question, and I should have been more explicit about this. Any IDR plan credit can be credited towards another IDR plan. So you can jump between IDR plans as much as you want. I don't know why you would, but you could, and then you can still build credit towards 20 or 25 years for cancellation.
Okay.
Only repay is going to become save. So if you want to get the benefits of save, you have to either switch to repay now or switch to save once they've like turned on save, basically. So if you're in pay or ICR and you're eligible, which is basically anyone but a Parent Plus loan borrower, you should just do one of those two things. Make sure you're in repay or just directly get into save once that happens. I will also take this chance to sort of, because I split this up in the presentation, I put it in like updates, not in the IDR part, but that IDR account adjustment for this moment in time is effectively making all of the, like it doesn't matter what plan you're in, you just have these like wild card IDR credits that will work for any of your past time in repayment. So I think a lot of people have this concern about, oh, well, I wasn't in the right plan or I was in that one or this one. going forward, as long as they do what they need to do to make sure they benefit from the IDR account adjustment, so consolidate by the end of the year if they need to, they can think of themselves as having sort of these applicable to any plan wildcard IDR credits, and then get into save is for most people going to be like the best one, right? So I feel more confident these days than I historically would have been saying get into this one plan because it's going to be so much cheaper for you. And it doesn't really matter which plan you were in before that.
So isn't repay just for financial hardship?
They're getting rid of that, and that the save is going to be opened up. And I
Right,
think that,
but that was, so I'm in pay and
Yeah.
not repay because of the financial hardship barrier. And so that won't be a barrier to getting into saves. Saves will be
no,
much
once
more.
save replaces repay, so far this is what they've said. They have not said that there will be a financial hardship component in save. And if for some reason it comes up that's not the case, Jacob and I will email out to everyone who attended here to clarify that. But they are, except for the Parent Plus loan type, right, which is a huge accept, they are making it available to everyone with a sliding scale of which benefits go to them, 5 or 10%, but the plan itself should be available to anyone.
Okay, so what you're saying is pay can convert to repay right now? Even
They-
without the financial hardship part?
Yeah,
Or we
that-
have to wait till save starts?
I don't know, maybe Jacob does, but I don't know that they've been explicit on that. This has been sort of, to their credit, the Department of Education is doing a lot of amazing work. To their discredit, they're doing it all at once and figuring it out as they go along, right? So there are like totally appropriate questions, like not appropriate, like practical questions people have that they don't necessarily have answers to. I don't know whether how that component works, and I'll see if I can sort of figure it out while we tee up another question. But at some point there will be a save option directly once they sort of flip the switch and convert it, and you'll be able to access it at the very latest at that point.
And at that point, we just have all our participants look to convert if they're in an IDR, they're
Yeah, I
having
mean,
them.
yeah, and
We want
again,
them
it's
to
like,
convert to saves.
yeah, that is for the vast majority of people going to be. And actually, I thought this might be the case, and I didn't want to get it wrong, but I think it actually might be the reverse of what you're saying. I think pay has the partial financial hardship, and repay doesn't. So repay is already a more accessible option, and so there shouldn't be that barrier even to entering repay. I just double checked the slide from the presentation, and I believe it's pay that has that, and then they came out.
Okay.
Obama did with repay, which got rid of that, and then save will be even more accessible.
Okay, awesome. Thank you.
Thanks, Sean. And I will note for folks, so the city partners will next week have a session, your city and county colleagues will have a session talking to Bonnie Latre, who is the student loan ombudsman that Winston mentioned as sort of a resource, that office of the ombudsperson at FSA, which is the section of Department of Ed that actually handles the loan servicing. Bonnie is wonderful. She's really good to have in that position. And I will just say, Sean, that probably her biggest point of emphasis to me was like, as people are working with clients, they're going to want to get them into repay, right? And so that's their thinking, is certainly helping people move into save automatically. Great. I want to go. I think we may have covered this, but Maria Holguin had a question about consolidation, when it may be worthwhile if you have federal loans. So Maria, maybe let you unmute yourself and ask that question just to make sure we cover.
Yeah, sure. So yeah, I just want to know if it's worth it for me to consolidate my loans, because I am in the PSL program, and they said that I wasn't eligible because of my payments, that, you know, you have to have 120 payments, and I don't have those yet. But I was, you know, thinking about consolidating, but I have federal loans. I don't know if it makes sense for me to do that.
Yeah, so thanks, Maria, for that. So a couple of things, and again, we have a whole separate hour-long presentation on PSLF specifically, so we're just sort of touching on each of these programs. But in general, yes, you need, whereas for IBR, you are annually touching the programs you have to recertify. For PSLF, you technically, as she was alluding to, you technically don't have to fill out any paperwork, do anything until you have the 10 years, 120 payments, and then you can get your cancellation. However, it is best practices to do it annually. Annually, you fill out the certification form that shows where you work. Your employer signed it. It's a 2-page, like 5 pages of instructions, but the form is just 2 pages, front and back. And then they will add 12, you know, say you do it annually, the servicer, once they process it, will add 12 credit increments to your account until you get to 120. So doing it annually is a really good way to make sure you're on track, make sure there's no issue, see your progress 12, 24, 36, et cetera, until you hit 120. So even if you haven't hit, we hear this language a lot because the federal government uses it, whether you're eligible for PSLF, because I'm doing air quotes here for anyone who's just listening, because you don't have 120 yet. I find that misleading, even though they use that language, because you're eligible for it, again, air quotes, you just haven't hit the threshold yet. So I think it's helpful for people to do it annually. And it's not like a program where you missed the deadline to apply. It's like you didn't, because it's always retroactive, because you're showing that you did the work in the past that you're getting credit for. It's never too late to enroll in PSLF, but I would suggest doing it early and often. And certainly if you ever switch employers, just to make sure that they qualify. For the question of whether you should individually consolidate, I can't, without sort of doing more of the intake and understanding your circumstances, say whether you should consolidate for PSLF purposes. But I will say, if you already have a direct loan, then there's no need to consolidate, because that's the eligible loan type. The only people who need to consolidate for PSLF purposes are anyone who has a federal loan that's not a direct loan, and you want to do that. And then just another point that Maria made is that I didn't mention in this is, she said she has federal loan, should she consolidate? And again, consolidation as a term is specific to federal loans. When we think about it in the private context, it's refinancing, right? Now, a huge risk that some of your clients may experience, and some of you may have also experienced or at least witnessed, is when private refinancing companies start to encroach on that and make you think you're consolidating, and then you refinance. And once you refinance with a private loan, you're out. There's no way to unwind that, and you have no access to basically everything we talked about in this presentation. Once you leave the federal student loan system, it's just, that's it. And it's really heartbreaking. And people think they're consolidating. It ends up they privately refinanced, and there's just no way to undo it. So that's another big red flag to look for when you work with your clients.
Thanks, Winston. And maybe a good time too to just shout out, this is a group that's pretty aware of looking out for scammy looking private offers that their clients may have received, right? And we can refinance this, we can give you a loan, we can help you access tax credits, we can do this for you, just pay us some sort of fee. And we know that that is 99.9% of the time that's bogus, and they're charging you a fee for something you can do for free. I don't know if there's any more you would say on this front, Winston, because of course, even in addition to the refinance offers, there's all sorts of scammy companies that are popping up representing themselves as helping borrowers when they're in fact doing just the opposite.
Right. And one red flag there is, and I think you all probably appreciate this from your work, you never have to pay someone for these programs. All of these are free to access. Someone might choose to pay for the benefit of a person doing work for them, but they never have to pay for access to these opportunities, right? So there's a big distinction there. And especially if someone, most of these things are actually a little bit easier to access than you might think. And so, we hear these stories of someone paying a company to consolidate their loan for them, to like do the consolidation application. And then often what happens is they take the money, they never do the consolidation, and then the person's out of money and didn't get the benefit they wanted. So even some of the scammers might be an actual private company scammy in that they're taking you out of the financial aid system, and some of them might be just like totally fly-by-night scammers of not even providing any service and pretending that you have to pay to play in this and taking advantage of borrowers.
Great, thank you. Move to another question from Adriana, who asks about DACA students. DACA, for folks who are not aware, federal program that protects undocumented immigrants from being deported, also provides for a work permit. There are opportunities that vary often by state for these DACA participants and their children to access college and to get some level of loans. I'm sorry to jump on your question, Adriana, but we can either leave it there and have Winston talk about DACA, but is there anything more specific that you wanted to ask?
No, it was mainly just trying to understand how undocumented students who may have been here since they were, a few months old, and, grew up in the United States, but not knowing that their status was immigrant, or that, they knew, but they still were able to go to college and all that. How do they get to tap into? We find that we do service a lot of youth that have been here for a really long time, pretty much their entire life, and then find out that they may not qualify for certain benefits because they are undocumented. So how does DACA fall into this, these federal programs, these ways of assisting them in repaying? They're our most vulnerable in our communities.
Right, absolutely. Thank you for asking that. So my understanding, and I just checked on their website to confirm this, is that so you have to be an American citizen to benefit from federal financial aid. And DACA and undocumented individuals, including DACA students, can still be a student, are not eligible for federal financial aid. I don't know about the policy work to change that, which seems like it is a totally meritorious, worthwhile change. I come from a consumer background, so I'm more like, you have the debt, what do we do with it? And less about accessing higher education. But it looks like from the studentaid.gov website that DACA students, DACA individuals cannot finance their education using federal financial aid, unfortunately, which means that the repayment plans and things are not relevant for them. They might have private student loans, but all the federal things we talked about today wouldn't be relevant for that.
Okay, got it. Thank you.
And then there's a narrower category, Adriana, for, I previously worked for a city and county of San Francisco. So California does have a smaller category of Dreamer loans that I'm not expert on, but I don't know if there's anything more you would say about Dreamer loans, Winston, or certainly for anyone in that position, we can find the right California resource to follow up with.
Yeah, I don't have much more to say about Dreamer loans other than I agree it exists and it's worth looking at, but I will say it's a great flag that I didn't include in the slide deck, which is that a lot of states have state sort of like analog programs to what we've discussed. They don't have, like, Dreamer loans is an actual lending program. They might have loan programs, but what they do have, many of them, is like IDR companion programs, where if you work in a certain field or in a certain high need area, the state will basically make your IDR payments for you for a period of time. So if you're like in New York, it's like if you are a teacher in a high needs area, or you're a legal services attorney or a public defender or something, you can get like up to 3 years of IDR payments. And they make it an IDR payment because they know that you're eligible for PSLF, and because it makes it a lower payment for the state to have to then dole out themselves. But it is worth looking in your state to see what are these state supported student loan repayment programs, many of which piggyback on top of the federal repayment options.
Thank you for that.
Thank you, Adriana. Appreciate it. As I scroll down, I do have one question from M. Garcia, a financial counselor who gets clients who have questions about student loans and asking about a way to refer them to you, I'm assuming to Winston. As I said, in a perfect world, we would clone many Winstons and have them on standby for everyone. At this point, it just doesn't work out to directly do those referrals. But my suggestion is, start with your team locally, include your city colleagues who are going through this program with us. If there's no help there, or it seems like the next best move, reach out to me and I'll sort of take that on of finding out the best person to connect you with, whether that's maybe some legal resources, maybe some of the other experts that can help out with this. So that, I think, broadly applies for everyone. Let me just make sure, I think there were just one or two other questions.
I'm also, just to jump on that, I'm putting in the chat, let me just make sure I do it to everyone. Meeting group chat. Okay, hopefully that went through. This is the studentaid.gov list of state level student loan ombudsmen. I mentioned this already, so you can look and see if your state, if you live in one of these states, and it might be worth creating a relationship with them. They probably aren't structured in a way to receive individual client counseling. There's a distinction between helping resolve a complaint or dispute and counseling, right? I think you can all appreciate the counseling is much more in depth, much more laying out this person's financial life and figuring out what's going on, but they are probably still a great resource and might be worth proactively reaching out to connect with them, so that if things do come down the line, you can draw on them when you need them.
Thanks, Winston. So T. Beckwith asks, if someone gets the loan charged, do they have to pay taxes on that amount? I'll let you handle this, Winston, but good and bad answers to that.
Right. So there are some programs where in the federal law, the discharge program provides that it is not a taxable event. So public service loan forgiveness, never going to be taxable at the federal level. In most states, either mirror federal taxation. So when a debt is canceled, it's considered income, taxable income in general, right? And states have their own tax code, many of which mirror the federal government with respect to how this works. So I'm going to talk about the federal level, and that is mostly true about state tax liability, but not 100% true. So some of the programs are provide that it's non-taxable event already in the federal code. That's like the public service loan forgiveness. That's like the total and permanent disability, I think. Borrower defense. I hate to think of it this way, but like I have found it as accurate when I was in legal services. I found this to be accurate. The ones where it's like a really like cynical public policy would think of it as like a sympathetic circumstance, right? And unfortunately, the IDR plan, which there's not a lot of public sympathy for low-income people, is considered taxable. So if you get the 2025 year cancellation, that is considered a taxable event. However, under ARPA, one of the recovery bills laws from 2 or 3 years ago, no federal student loan discharge is taxable through the end of 2025. So all these changes we've talked about are going to result in more people getting debt cancellation than historically have happened. And this is happening during a period when none of it is going to be taxable, which is a good thing. And then we'll have to do continued advocacy to make sure that after 2025, none of that discharge is taxable, mostly the IDR discharge, because for the first time ever, people are going to start routinely getting IDR discharge because the program is going to start working better, and it will be taxable starting in 26. And so TBD, put a pin in it. Let's circle back in 2 years. But for the time being, none of it is federally taxable.
Thanks so much, Winston. And I know a lot of advocates all around the country, whether it's at the federal or state level, work hard to try to protect your money in these sort of federal benefit programs from being taxed. So find your local advocates and raise your voice too. Antonio asks about finding more information about the bankruptcy discharge you were talking about for federal and other student loans. Winston, are there any good places to send folks there?
Yes, there are, and I'm just pulling up a website that I'll drop into the chat. I mean, the bottom line is it doesn't really change the process so much, but here is the DOJ press release about their changed standards. You still have to go file, you still may have to have an administrative proceeding because the loans are still that heightened standard. So that process hasn't changed, but the federal government is not going to be as adversarial in that process, and hopefully the judges will pick up on that. So I just dropped the DOJ's website in there, and as more practitioners start to use this new guidance, I think we'll see more resources, but it's been less than a year and only so many people do student loan discharge. So that's just sort of taking time to catch hold.
Thanks, Winston. I think we are at the time where I could just turn over to folks who have questions they may not have dropped into the chat. So feel free to unmute yourself and ask a question or raise your hand and I'll come to you next. Anyone have other questions to ask? Okay, and while you're thinking, I will also say it's not your last opportunity. As we said, we want to come back and look at a follow-up, at least one follow-up training and potentially more. We also, and I want to really pump this up again, I'm sending a post survey out to folks that I really would love for you to fill out. That is an opportunity to say, well, I got it over here, but there was a section I'm still a little confused about. I could use more. It could be as open-ended as that, or it could be very specific and drill down to the details. So there will be an opportunity for that. Let me go back and make sure. Please do jump in with a question if you have one, and I want to make sure. I answered a question in the chat, Winston, then maybe I'll just double check that I answered it correctly. I think I wish there was another way around this. Ash asks, can private loans become federal loans? I said, unfortunately, there is no method to go that direction, right?
Correct. Yeah, it's true both ways, right? Once you privately refinance a federal loan, you can't undo it. It's now just a private loan, full stop. And if you start with a private loan, you cannot make it a federal loan. So there's a pretty big firewall between the two.
Great, thanks. Okay, anyone else with a question? So really, thank you for this great group. I think we had more than 100 people on at various times here throughout the presentation. I agree with whatever everyone said. Winston, thank you so much. Really clear way to boil down some very complex and otherwise confusing information. And just a really good time to be talking about this. Obviously, following the Supreme Court decision and and how this is in the public eye, but also now we really know there will not be a change. You're going to start having interest accrue on your loans in September and repayments starting to be due in October. And so really this is a time when people who have been letting this be way, way, way on the back burner for a long time will need to kind of grapple with it again, figure out again who their servicer is, figure out what they owe and what programs that they can qualify for. So if you're not, as Winston really made the good point, if you're not already sort of including the prompt, asking whether clients have student loans yet, this is a good time to maybe start doing that as well. Any other closing thoughts you might offer, Winston?
Just to plus one everything you said, and just a reminder that this is confusing stuff, it's esoteric stuff. There's not a ton of expertise. So nationwide, there is a movement to grow this expertise at the community level. It's happening in cities, and you all hear it's happening in other calls we're in with legal services providers. So I would say, let's not have a self-fulfilling prophecy of like, we're not going to offer it because no one's offering it and it's hard to get the resources. Like, let's all work in tandem to make sure that folks can access this kind of assistance and resources in their community. And we're here, and Jacob especially, and I are here as resources to help do that. So thank you all for taking 2 hours out of your day. And we're really looking forward to following up with you and making sure your communities get the benefit of this information.
And that's my goal as well, Winston. And, for all of you, I think many of you have attended trainings and been involved in Cities for Financial Empowerment work, right, around the FEC centers. And maybe you work at an FEC center or something that is essentially akin to that. We're going to continue to have the conversations with the FEC folks and the CFE folks as well to identify where's the best source for ongoing training and professional development. It's really important. This is after mortgage debt. This is where people owe the most of their money. It's a substantial piece of your budget that's coming due again. So we'll continue to chip away at that. Well, thanks very much, folks. I will be following up with the slides, with the recording, and with that survey that I want you to fill out, and enjoy the rest of your Thursday.
Thanks all.
Thank you.
Thank you so much.
Thank you. This was great. Thank you.